Great. Welcome, everybody. We see you all rolling in. We're just going to take a minute while you get, all situated, and then we will get started in about a minute. Great. Welcome, everybody. See you coming on in. Actually, I'm going to go ahead and get started. We'll just do the introduction so that everyone gets a chance. Hi, I'm J.Thelander. Welcome to our CVC compensation panel. I'll introduce my colleagues and let them give a little bit of information about themselves, but it's nice to have both Lee and James here. And James is from DLA Piper, and Lee is from Bell Mason Group. And Lee and I have known each other for many years, also from his previous role at Intel Capital on the corporate venture side. So Lee, I'll turn it over to you just to share a little bit about your handle on the CVC world and what you have going on.
Great. Well, nice to see you, Jim and Jody. So yeah, Jody said I was with Intel Capital for many years and led our portfolio development team. But actually, before I did that, I actually was working in human resources and helped to establish Intel Capital's first synthetic carried interest plan, and it made a tremendous difference with that organization. And since leaving Intel Capital and joining the Bell Mason Group, have done a lot of compensation work as well, mainly team design and kind of structuring of the organization. But we've always used Thelander's data and are very pleased to be talking about this topic today. It's an exciting area, and we're seeing lots of growth in CVC. So eager to get into the discussion.
Great, thank you. I will say Bell Mason Group and your founders have been very instrumental to designing all the questions that have gone into our surveys. So we rely on you heavily since you're doing the design and structure with CVCs. And James Fisher from DLA Piper, also been a long partner of ours. And without you, we would not have had even the first CVC compensation survey. So fill us in a little bit of, James, what you've got going on and what you're seeing in the CVC world.
Yeah, good afternoon to everybody. Good morning. Nice to be with you all. What am I seeing in the CVC space? Well, it's an interesting time to say the least, but we're as a firm seeing all kinds of activity both on the formation side and on the portco side and on the debt side. So excited to have the conversation as Lee mentioned, and look forward to your questions. Hopefully, Lee, it's nice and interactive here.
Yeah, exactly. So by way of just sort of ground rules here. First of all, we have someone monitoring the Q&A and will relay the questions to us. We would love this to be interactive, and if we're showing something you have another question on, or you'd like us to go back or expound upon something, please jump right in. There's a tremendous amount of information here. And also, you're welcome. We will send out a recording of this, but if you do happen to take a picture or capture the information on the slides, just to let you know with the copyright information, please just use that as a personal reference and not go ahead and post it or share it. So without further ado, I'm going to jump into the slides, and we will start with just by some way of background here. So we've been running comp surveys and looking at data for both private companies as well as investment firms for over 25 years. And in addition, today, we are excited to announce that Thelander's been running our surveys, and they run all year round, and the data is real time, meaning we pull the data down. We pulled the data for this webinar, for example, earlier this week. So the data is very current, and we have multiple surveys on compensation for corporate venture firms. We look at carried interest and corporate stock, salary increases and bonuses. And then we run in parallel with all of this a separate set of questions for investment firms, so venture, private equity, hedge fund, family offices, as well as for private companies. So really, we've covered this whole ecosystem, which, there's multiple sets of data that are always applicable to use for CVCs. We also are running a CVC digest, which we publish now monthly, which, and I know that Lee and James agree with this, the data is great, but you've got to turn it into something that people can use. So that's what we've been doing since this past year on sort of how much the carried interest is changing, and United States versus Europe for CVC compensation, vesting times, a whole host of topics that take not only our data, but turn it into analysis. Okay, let's look at a little bit of background just with the data so everybody's comfortable with our starting point. So each year we have now over 2,000 investment firms that participate globally in all of this compensation. And for the investment firms, and Lee, you and your colleagues over at Bell Mason Group have been really helpful to continue to expand this. I think we started with like 3 or 4 jobs when we first did this. And now we go all the way from the top person, the CVC unit leader or corporate level executive, with multiple jobs in the portfolio development, which has been a job that's become very important and on the rise, down through the associates, jobs that are competitive in the venture space as well, an associate, analyst, and all the levels of position, CFO, COO. These are the investment firm positions, which also have really grown and I think sort of taken a page out of the CVC playbook, and that they're providing a lot of portfolio services. Lee, if you could comment on that, that would be great. CVCs, used to be the ones who were taking that end-to-end solution, and VCs were just having the investment professionals. And now you can see there's all kinds of parallel lines.
Yeah, and I was going to say, Jody, when I first met you, we were really just starting on this, and through the Bell Mason Group, we started to realize that there was a need for titles like this. And, titles are somewhat controversial in corporate venture. Oftentimes the external titles are different than the internal titles, which are used. And it's kind of hard to decipher who does what. But, I think one of the things that we've done is, as we've seen the emergence of these new jobs and job families, we've documented what the different layers and the different levels and job functions are really all about. Probably the most important one in my mind has been the emergence of the corporate venture business development role. And that's something that was almost unheard of 10 years ago, and now it's quite commonplace in corporate venture groups. And a whole emergence of other just the fact that you have so many jobs listed there is extraordinary.
Yeah, and that whole CV.
That I'm just curious. Chief of staff is one that we're starting to see more and more of in various different levels, and it's kind of, I think it was on the bottom left of your chart there, and that obviously is an interesting title and can take on many different kind of levels of responsibility, etc. So it's interesting to see sort of the C-suite titles sort of begin to expand as well. And then Lee, as you mentioned, right? I mean, it's somewhat controversial. It's interesting for us as lawyers to look at how CVCs are interacting with their parent companies, and where titles, and oftentimes titles meaning comp structures, don't match. How do you deal with that? And that can be certainly challenging for lots of people, and can get difficult at times. But that's what we're here to talk about.
Especially in places where there's a legal or a company norm or a country norm to have something related to being a director or managing director, or some companies are very liberal with vice president titles. Some companies don't allow them unless you're like one of the top named officers. So all this is interesting, but I think the other thing that we've seen with this is a tie to the operating models, and I'm sure we'll get into this, but depending on how you're structured, can also influence what kinds of titles you're permitted to use. And but the days of having to have an internal title and an external title still exist for many organizations.
Well, and having the comp structure is very it's can be tied to the parent company, but it can also be very separate. So I'm just going to share quickly a little bit of background. So this is of all the firms that we survey. So you can see, obviously, venture is a big piece of this, and it makes sense because that's been the base of the whole infrastructure. Really, is the investing model. So in the private company world. And then also where your CVC unit is headquartered, still 74% within the US, although they may have offices other places, which can also adjust the compensation model, right? Sometimes in other places, people want to have a different comp structure.
Well, and I think it's great to see that your data continues to expand globally. And we see these organizations starting in Europe or in the US and then extending into other countries where there's almost no data. So this is a great development to see this starting to grow.
Yeah, and also we did show here, and now that we have a substantial amount of data, we have been able to look at the comparing and contrasting between Europe and the United States, because there are some differences. And then also the primary location of your CVC unit within the United States. And again, it really covers the country, and geographic differences in compensation are really not a consistent way to look at compensation. It just depends. And then the primary location within Europe. And again, we've had enough data now to be able to show these kinds of slides and further look at compensation. Okay, so the other piece of this that really comes into play is the total corporate venture investment capital under team management. And you can see that sort of sweet spot in the 100 to 250, 250 to 500. And we are even now are getting up, and James, I'm sure you're seeing this in terms of structure, right? You have a lot of emerging CVCs, but you also have now those that have the, 1 billion plus in AUM.
Yeah, absolutely. I mean, as the CVC space continues to evolve, you've got several folks that have really kind of developed amazing portfolios. In some cases, holding that portfolio a little bit longer than they'd like these days, but that's a testament to the capital markets and the debt structures that are unfortunately with us here. But certainly hope to return to days where those capital markets are more open, and that doesn't mean that AUM is not going to continue to rise, but certainly give people an opportunity to find exit strategies.
Right, but I think it also goes to the point that CVCs are a very heady part of the ecosystem, of the investment ecosystem. And so we've had to grow on the venture side to the firms that have $7 billion of assets under management. So this is really keeping par with that, because firms are, IPO market is lackluster, the firm's AUM is growing, and it is impacting compensation. So here's the next piece of information that's sort of, let's see, the amount of corporate allocation for 2023, and this goes to the different ways that CVCs are structured. But you can see again that these numbers, they're still small amounts just for an allocation, depending on how much the capital they're going to deploy or how much they deployed in, whether it's early stage or late stage companies. And the reason we show this background is it all goes into the different comp levers and the strategy for the other incentives. So I'll lay out, I know we have, everyone on the webinar here at various stages of their CVC development, but just for clarity's sake, we look at compensation, the cash compensation, with different levers. One is the base pay. And then we survey current bonus, which is the bonus that was actually paid out. We also look at that as a percentage of base pay. And then we look at total cash, which can be a combination of base pay and bonus, or some individuals just get a base pay, right? So that's why they don't add up. The base pay plus the bonus does not equal total cash in all cases. And then target bonus, which is the short-term incentive out on the horizon, typically paid within another year. And then the other incentives include corporate stock, shadow, phantom, synthetic carry, all mean the same thing. And then we also look at carried interest, which I know everyone's interest is always peaked in that, but obviously that is not something that is used in every corporate venture firm. And that's a percentage of the fund's profits distributed to the CVC team members. And then this is sort of the golden chart here, is what are the other incentives, because this comes up. And both James and Lee, as you were saying, these later stage CVC firms, CVCs being very competitive in terms of their deals and with whom they're syndicating, feel pressure to somehow juxtapose themselves between the parent company's compensation and then understanding how they're going to recruit and retain talent coming from the VC world. So Lee, as you're navigating and doing consulting for firms, what kinds of topics come up on this?
Yeah, well, I think so a couple things is, one is, your graph showed a couple interesting things there in terms of kind of up and to the right with increases in both carried interest for programs that are established to offer that, or the phantom carry, synthetic carried interest. I think we've seen those continue to grow. I mean, it wasn't that long ago they were in the 10 or 12% or almost unmeasurable range. And so I think this is a pretty dramatic growth. I think one of the things, though, is that you kind of alluded to this, is that not every corporation offers carried interest or synthetic carry. And in fact, corporate stock is a very attractive offering for organizations that can offer that. That's just simply not available in the venture capital world. And I think that's one of the things, is there's kind of a sense that being compensated like a VC means all the goodness that comes with carried interest, but that doesn't necessarily come with corporate stock, which is a really attractive element of compensation for people that have that available to them. Yeah,
James, can you explain to us a little bit? I mean, the corporate stock, we can look at the section of it. I'll pull it up.
So, I mean, I think the thing that's the most interesting for me when we talk to people about, the distinction between corporate stock and whether it's carried interest or synthetic or what have you, is how are you being measured, right? So if you're thinking about carried interest or shadow carried interest, you're being measured basically on either fund performance, occasionally on a deal specific, kind of performance that's a little bit more rare, at least in our experience. But you're looking at a pretty finite area of either success or lack thereof, whereas the corporate stock obviously has a much broader base of success or not, because it's talking about the success of the corporate parent as a whole. So there's positives and negatives to that, right? You're not obviously in complete control over how you are compensated based on the success of the corporation. Obviously, in times like we're seeing now, there's a lot of fluctuation in that stock price for many large publicly traded companies. It can be used as a great lever if prices are relatively depressed for a company, and and they can use it as a way to kind of compensate people at a relatively low entry point, as opposed to a carried interest, which is obviously based again on how long and how successful you are with particular funds or particular investments. And then, the last thing I would just sort of say is, again, as hold periods are becoming longer, the carried interest, the time periods under which they're measured, and even sort of the tails on them are beginning to become somewhat challenged in certain cases, because again, we're in this sort of unfortunately strange time, but hopefully we come out of that strange time soon and get back to where we are. I couldn't agree with Lee more, though. I mean, the idea that you're at 32%, which was surprised me, to be perfectly honest with you, on carried interest for the CVCs that have been.
That's why we did the year over year. I mean, we've been doing this now for 8 years, right? Yeah. So I'm going to share a little bit more background, and then we can get into the specifics, because I feel like when I jump around, we then wish that we had started with the basics. So here's also the year over year, and then here's Europe versus US, right? So other incentives in addition, because it comes up all the time. And I mean, James, I know you're in Europe right now doing a deal. So there's obviously a large European contingency on the rise. So it comes up. So you can see here that the corporate stock and carried interest, the combination of things, that really the corporate stock only tends to be the highest one. So it's more, I think in the US, given the fact that there are so many VC firms, that the talent market is coming from venture to corporates as well, makes this a little more attractive to have both. And then we've done a lot of analysis when we're consulting for clients on their comp strategies, and we really just look to see how are you looking at the CVC unit structure and what's the impact on the additional incentives. So, and James, maybe you want to talk about this, and Lee, because these questions all came from you to put in the survey to begin with. What is the structure of your investment firm? And so, obviously you can have the James or Lee, you want to jump in and talk through this?
Yeah, well, I mean, I'll just kind of start the ball rolling, and James can pick up from there. But I think I guess one of the things we've seen is that I see a maturing of corporates' approach to this, and there's no right or wrong way to do this. But traditionally, we see people basically doing just investing from the balance sheet, and now we're seeing even new organizations establishing themselves as a separate legal entity and having more operating freedom than they might have had previously. Mostly we see them trying to kind of earning the credibility, starting with the smaller AUM, and then now I was shocked at the numbers you showed a few minutes ago, Jody, which indicated that really $50 million is kind of the bottom limit of what you see. 100 million and up is not uncommon, and I think that's just the maturing of the organization, and I think people are also realizing there's lots of different operating models and ways to structure their organization. I'm sure James is seeing the same thing.
James, I'm going to show you the next slide so that you can speak to this, because what we're seeing is the other incentives in addition to base pay and cash bonus by the unit structure. And we're seeing that the more independent the off-balance sheet or separate legal entity tends to have a greater percentage of either carried interest or shadow or phantom synthetic carry. So and you're doing the fund, structuring. So help us understand a little bit how this works.
Yeah, I think that makes a lot of sense, actually, if you think about it, right? So the idea is that you're off balance sheet, and you have a pool of money and you're investing, based on your criteria, and you're being rewarded on your success. That concept of the carried interest or the synthetic applying to how you're deploying that capital makes all the sense in the world, as opposed to a scenario where your thesis or your fund structure is more tied to the parent company and the parent company's performance or the parent company's goals. And a lot of it has to do a little bit with what your basic thesis is, right? So are you forming your CVC for financial returns? Are you forming it for both financial and strategic returns? Or are you focused solely on strategic returns? Not that any CFO is going to want you to lose money, of course. That's never what companies want to do. But the idea that you're focused on a core group of particular types of investments, and they can be a lot of times out of the core business of the parent company. And you're saying, look, this is what we're going to do. This is where we're going to put our money. We have an investment committee, yes, but we've got that independence, and we want to be rewarded for that success. That makes a lot of sense to us, and it's something that when we help people form these things, we focus with them on as to what are your goals, and what are the parent company's goals. Obviously, ultimately, it is their money, but how are you structuring them, and ultimately, what's the what's the governance process that you'd have to go
Right.
through
So
to make an
when
investment?
we look at the shadow phantom carry, for example, let's drill down for a minute, right? We ask, how is it calculated? And so that is either a change in the fair market value of the portfolio only, or a percentage of the return from the exits. And then we further our combination of both. And we ask, how is it paid? It's usually in cash, right? And then we also, this is the bonus pool. And this is where, James and Lee, if you want to talk through this, because this goes to your question. So if you're with a CVC unit, these are really good questions to ask. What is the goal, right? How is this being asked? What is the priority related to the parent company? And how does that impact the comp philosophy? Because the pool that's calculated for something like synthetic carry or even for carried interest obviously is different than corporate stocks, a direct line, to the success of the parent company. But these other areas are where you want to delve in and really understand. And that's why we drill down to this level, because it's not a simple answer, right? And you can see that it can be a combination. I mean, James, you want to talk to us a little bit? And Lee, you're smiling because obviously you're dealing with this.
Well, yeah,
Lee,
go ahead, James.
Go ahead.
All right,
Lee,
James, you go.
You want me to go? Okay.
Yeah.
Can I actually go back to the one slide for a second before we talk about this slide? So let's just, if we could talk about this for a minute, right? This idea of how are you calculating, whether it's the carried interest or the synthetic carried interest, and the combination of really a change in fair market value versus a return, or these two other numbers, which I was interested to see, both 9.4%. So, I think it's interesting when you talk about a return that is calculated based on a change in fair market value, when in some cases you're dealing with illiquid securities. So that could be a very interesting sort of governance question at the outset of your formation. If you're going to have a carried interest and you're going to calculate it based on fair market value, how is that fair market value calculated? Who's calculating it? How often is it calculated? Things along those lines become kind of a critical question. And a lot of times they're difficult to answer. And so you revert back to the exit. Well, here, we're in a situation where the exits are down. And so the idea that carried interest is going to be based purely on exits might be a little bit more challenging. So I'll speculate here and say we might see that 9.4% number go up a bit. So thanks for humoring me for a minute there, Jody. I just wanted to kind of touch on that because I thought it was an interesting kind of slide.
It's very important. I mean, we're trying to put this data into context right now. And I think that's exactly right. With the IPO market and the exits being down, then as you're forming a CVC or you're talking about compensation, then these are all factors to take into consideration why you have to adjust on a regular basis. So Lee, you tell us.
So I'm glad that James went to this slide because, if you think about it, the challenge with the change in fair market value is, sometimes these markups and marks downs and impairments can just fluctuate so, drastically. And, the market does what it does. So sometimes, that can result in a situation like clawbacks, which I'm sure you'll talk about. I think you got some data on that, which we typically want to
scary
avoid.
Word.
And, so I think, part of this is, it kind of relates to the structure of the organization and what you're trying to achieve. I mean, if you go back to one of the slides you had a moment ago, I'm sorry, it's kind of complicated, but
that's okay.
But I think,
this one, the calculated,
there's a couple other things that are somewhat controversial or challenged sometimes with this, and that is, how is it countered? Like, how do you calculate this? Like, two things I think come up is there a hurdle rate, and what is and how do you account for expense in corporations?
Okay, so here we have it. So here's the paid. I'll go through these. I think these will help you. Here's how it's calculated, the different ways, right? And then also calculated, we did by assets under management. And you can just see, we wanted to be able to show you consistencies of less than 250 AUM and then 250 plus AUM. And then we showed you, here we go, what fund expenses, right on the money, Lee. I'm sure this question even came from Bell Medicine Group. So what expenses are included in the bonus pool calculations?
Well, yeah. And so, I mean, this is one of the things that I think for our audience, and I'm sure we're going to get some questions on this and other things that we're talking about here, because we're moving through a lot of data very quickly. And, it takes some time to kind of digest these and what they mean. But, just like you can't control the exit environment, sometimes if you're in a corporate venture group, you can't control your corporate cost allocations either. But there's a lot of differences between the way corporates are treated and the way you're treated if you would be an independent VC. But I don't know if you'll talk about the carry percentages also that might be different, compared to a typical.
Yeah, we can jump to that afterwards. We have the comp data too, but I feel like looking at the cash and bonuses, that is more of a corporate philosophy and understanding. While we have a whole section on comp, I feel like this information is where the real, everyone always wants this in the consulting. And James, you see this must come up in fund formation as well.
All the time. And in particular, so if you think about the that 13% number, right, actual expenses, CVC team costs plus a corporate expense allocation. So a lot of that, the questions we see in here are, well, wait a second, I don't want an allocation of corporate expense because I'm not going to be using those corporate expenses or those allocations. And so there's often a negotiation in terms of sort of the CVC itself or the founders of the CVC and what they think they're going to use. And a lot of times it also goes to what the goals of the fund are. So for example, right, if you're investing within the core of a parent company, you're probably relying upon some of the corporate expenses that you might need, right, to develop either commercial agreements or to foster growth within the parent company as a whole, as opposed to those that are investing outside of the core or are have more freedom to invest in
right. So some of the benefit is that you're getting resources from the parent company, and then if you're a completely separate entity, then there's somewhat of that's not quite the same, right?
Exactly, and but that is absolutely something you want to be talking about up front, because as Lee mentioned, right, you don't get to control those allocations year over year, and depending on who's hired and where they're hired, and even frankly the organizational structure of the parent and who the CVC ultimately reports into can have impact on those allocations.
And I think it can evolve over time. So, it may start out that those expenses are covered by the corporation, but in time, as your returns start to come in, like you mentioned earlier, James, the corporate venture is not in the business of losing money. They're not necessarily, designed to be a profit center, but ideally, they can't lose money. And so, building in a cost model to compensate for that is important.
This comp data looking at a CVC unit leader, which is a year over year, 21, 22, 23. And this really goes to where you can see, obviously, it is safe to know. We don't share our list of participants, nor do we show who's in this exactly, because for obvious reasons. But you can see this is the total cash. This is base and bonus, or this is not including the value of corporate stock or the value of carried interest distribution or shadow phantom carry. This is just what we consider to be total cash. You can see 25th percentile, very competitive. The median, very consistent. 75th percentile, very consistent. But the max numbers are where there has been, we've leveled off now. We know 2021 was a very big year and a very competitive year. And what we get a lot of questions on how has comp changed. And really, as you can see here, comp has not changed dramatically, but it's the use of the percentiles. So a firm that is really trying to recruit somebody who is coming from a venture space, you're an off-balance sheet CVC, and you really have, you are syndicated with other heady VCs, you want top talent, and you may be looking for some financial return, not to lose money. Those are the people at the 75th and the max numbers. And these max numbers are not outliers. They are people that exist where there's a lot of data hovering. If we drop one number, the next number would be very close. So Lee, you're obviously seeing this in the design and the strategy of what you're doing. I mean, and you look at this numbers. So share from your perspective.
Yeah, I mean, I think, there's a couple challenges in there. And so one, obviously, is you need to be able to recruit. And oftentimes you've got a challenge of kind of maintaining your internal equity with other executive positions and being able to attract and retain people that have a lot of viable options outside with other VCs or other programs and so on. And so I think one of the things that you're seeing with some of that is caps to compensation, especially where the carried interest comes into play, where it may be even paid out over multiple years.
Here's a question on that. Is there, I mean, everything you're saying, obviously, we've heard this more than once, because the nice thing about it being Thelander proprietary survey and data and information in real time is that if we get asked a question, then we go out and put it on the platform and we get survey data right away. So is there a cap on the maximum value amount of carried interest to be paid out? And 73% saying no.
Right. And I think where that may change over time is as the programs have more assets under management and the programs continue to mature and grow, where they have this potential and people stay in place, they're going to be eligible to getting these huge returns, and all of a sudden people start looking and say, well, wait a minute, how is the head of venture making as much as our product group general manager? And those are the things that I think will lead to the caps for the really large organization.
Now we have enough data, and James talked to us about this, where we can look at assets under management for CVCs. We didn't used to do this. And of course, that's the number one way, to be crystal clear. And I'm absolutely sure of this. It's the number one way to look at VC compensation. And it's very typical that the larger the assets under management, the larger the cash compensation, and then the carried interest percentages, get a little smaller because the pie is bigger.
Right.
And also you have to,
Sorry, just say two quick things just on the prior slide. I mean, just to level set, right? We all know what 2021 was in terms of exits, right? Which is, I have to presume, what drove that number in terms of it spiking over, not double, but no, actually in some cases, I guess over double what on the max range. So right there, that almost $2.3 million number, and in many cases was driven by the fact that there were so many exits and what sort of carried interest was available. I think the thing that
this is just total cash. I think what it shows, though, is just the competitive nature to keep people who would maybe have made a move.
2021 was just in both the M&A markets, the VC, and every kind of financial market you can think of. The thing I agree with Lee on in terms of the caps, and the argument I always hear, or I should say hear often on why there should be caps from the parent company's perspective, is that they don't have to go out and raise the money. The money is there. There's not really that level of fundraising and the time it takes to go out and raise the money. So if you don't have to do that, why would you be compensated as though you are doing it? And so, I'll be honest with you, I don't have a really good argument against that. I mean, there is, you talk to folks in the VC and the PE world, there is a tremendous amount of time and effort it takes for them to go raise these funds. And it's not to say that CVCs don't have to go raise the funds. They've got to go convince their parent companies that this is still, a viable investment and where the strategy is going. But that is often what we hear when we hear about why a cap is appropriate.
Well, and I would just say that we hear those arguments, and the other thing that I think is interesting is about many of these CVCs that they've matured and expanded is oftentimes they serve multiple business groups, so they've kind of tin cupped the funds from multiple business groups, and there's cases of many VCs that are taking outside money, CVCs. So in a sense, it's kind of replicating the VC structure with extra LP. So they actually are kind of leaning into that argument with a solution.
Let's talk about carried interest structure just for a minute. Now, you're exactly right. CVCs typically don't raise the fund. They're given it, as we see, in multiple ways by the parent company, and that they have different ways that they structure themselves, but nonetheless are not out raising money. So this is what form will the proposed carried interest come in? And this is, proxy equivalent paid as a cash bonus or direct assignment of carried interest or some other means of calculating a proxy equivalent for carried interest in the CVC portfolio on an annual basis. Well, the other thing that we know very thoroughly here at Thelander is, because we do a lot of venture consulting as well, is the question always comes up, are you contributing capital? So is a capital contribution GP commit required to participate in the carry program? And the sample size is 8, and they're all basically saying no. Now, that's obviously not the case in a VC. The top folks are definitely contributing capital for their carried interest, which very much equates to sometimes why the cash compensation is so much higher, because there are going to be capital calls. And then here's the total amount of carried interest for the firm. And this is similar because it's usually an 80-20 split for a VC firm. So similar, although there are some adjusted down. And James, you see this, right? So there are some adjustments down for a CVC firm.
For the exact same reasons we've been talking about, right? It's that they shouldn't. most parent companies are trying not to equate their CVCs to direct VC type investments. So yeah, we certainly see it. It's always a conversation that you're having with
Right.
folks when they form the entity.
Vesting time is running in the generally 4 to 5 years. And we see on the VC side that the carried investment, the largest area of growth has been in the 10 plus years. So we don't have that here on the CVC side, right? It's still lagging behind. But the bigger VC firms are getting very competitive in terms of extending their vesting time for carried interest. So I think this just goes more to the fact that it's not an apples to apples comparison. And then here is the total amount of carried interest for the firm looking by the assets under management. Makes sense, right? The larger AUM tends to have the larger percentages. And then here is the important part. James, you want to explain the clawback provision?
Well, I mean, just to say it at a high level, right, it is exactly what it says, right? So if an instrument is paid out and for some reason that investment fails down the road, there's a subject matter that would require you to contribute back that portion of the carried interest that you didn't technically earn because of whatever bad event occurred, whether it's an indemnification claim or some other kind of financial metric that ultimately doesn't pan out. Heavily negotiated time periods for clawbacks, amounts of clawback, cause of the event that results in the clawback, you name it, right? I mean, it's a heavily negotiated item, and we've of course spent a fair amount of time talking with people about it. And a lot of times the clawback will tie into that vesting sort of time frame as well. The longer, it's one thing to say you're going to have a 10-year carried interest hold period, so to speak, and then on top of that, a clawback that could go another 3-4 years, right? I mean, it begins to become somewhat challenging for the head of the CVC unit to see how this is beneficial to she or he. But it's the other thing I would just sort of say about that those time periods for a minute is a lot of that I think has to do, and Lee can correct me if I'm wrong, with just the amount of time that people are holding their investments at this point. So I think the CVCs are trying to hedge on sort of the hold periods that we're experiencing now, and that's why it gets a little bit tricky when you start to talk about how you value them versus the exit versus the mark to market sort of scenarios and sort of time periods like this.
You're touching on some issues. I think that's one of the things that makes corporate venturing so difficult, and especially when it comes to compensation, is that the business cycles of a corporation may be completely disconnected from the financial markets in terms of when exits are likely. And
sure.
So with that kind of scenario, you can have these, like 2021, depending on your industry, that could have been a horrible year for your corporation. And I'm kind of surprised that we don't see more corporations trying to do something with incentive stock allocations as a form of carry. I've seen some clients that are starting to do those kinds of things.
The other thing that's very important that you're touching on here is how consistent the CVC compensation is, and that these outside factors don't always impact it. And that's a very big difference, right? Is that you're seeing the corporate stock and the basic cash compensation. It's not subject to be contributing capital for your carried interest. It's very consistent. So you can see here, total cash compensation, 50th and 75th percentile by AUM. And it's what you would expect, right? The 75th percentile, even the 50th percentile slightly goes up with more AUM. And I know people want to see some compensation, just tables and data on. I know we're talking a lot of strategy and overarching, but I am going to run through some data because everyone wants to see. So here is here's the senior investment professional that shows you so this is the next level job down. So we're showing you base pay, median and 75th, current bonus, target bonus, and total cash. In some cases, the total cash is a combination of base pay and current bonus. And in some cases, the total cash is just base pay. That's why there's no straight addition here. But you can see the median and 75th percentile. And again, this can be customized by AUM, but this gives you some generalities, right? And then here is the year over year of the senior investment professional. The total cash is what we're looking at, median, very consistent. And the reason this is because it's the other incentives that tend to, fluctuate. But this is sort of the nice part. Now, here's a chart that I love is, here's Europe versus US. So you can see the US tends to pay more, which we know. And then this is the CVC versus VC for a senior associate. So now we're at a more junior position, right? We used to just have associate and not different levels. Now we have senior associate and associate. And you can see CVC versus VC. So in most cases, at the median and 75th percentile, higher for the VC.
Yeah, I think that surprises a lot of people. And, the VCs are really trying hard to hang on to these folks when the promise is just not delivering, so especially for these junior positions.
Yeah.
Yeah, and especially when you don't have to go raise money, right? In potentially difficult markets, which sometimes the younger folks are asked to do a lot of the sort of less than fun work in terms of the background for going and raising capital.
Right. And here's the CVC versus VC for a senior associate based on the total cash based on assets under management, right? So here's the VC less than 100 million, and then the VC 100 to 500 million and 499 and 500 million to basically $1 billion. And this is where you can see, this is why the point of this is to show you there's no just straight discussion of CVC versus CVC. VC versus CVC. The VCs have a lot of consideration. And James, you just absolutely said that. It depends on how big the fund is, what the senior associate role. This is where, comp data in a survey like what we do is so important versus just getting downloads from payroll, is because not all jobs are created equal. It really depends on all kinds of considerations, how much assets under management and where the leveling is. When we reslot people all the time, because and go back and call them in a firm and say, listen, your job may be a CVC unit leader here, but in the grand scheme of things, you're a senior associate. I mean, there's all kinds of different ways to look at this.
Right.
You're agreeing, but tell us.
No, I think it's, you got to ask the right questions. I think that's one of the challenges of interpreting this data. It's fantastic that we have the data, but you can't just kind of cherry pick the things that you want. You have to kind of step back and look at what is the job content, how does it relate, what is the assets under management, what's your track record as a organization, all of those things kind of fit in there in terms of the sales, the scope of the program, and who your real competitors are for talent. And I guess the thing that really strikes me with all of this is that what we're really trying to do with corporates with compensation is it's the retention tool. And
yeah, so here's the CVC hiring, right? Here's exactly those questions. What percentage of the current CVC came from the parent company, right? So it's a combination.
Yeah.
Right. And then who are the most frequent syndicate partners? Well, we know this, other CVCs and VCs, right? But it's just nice to have the data to confirm what we already know. And then if you hired from outside the firm, from outside the CVC unit or the company, yes, right? And here we go. Where are they coming from? Well, we know 52% are coming from, are answering, this is a check all that apply number. So, but VC firms. So we're coming from the private companies, some are coming from the other CVCs. Right. So obviously understanding the nuances of all this compensation is very important, right? And here's the change. This is a year over year analysis, right? This is 21, 22, 23. You can see that it's coming, the numbers are pretty consistent, that VC is your natural comparison. So it's very helpful to understand all these nuances because, we are seeing that there is turnover, right?
So yeah, that definitely shows you that as an employer, obviously you need to be concerned about retaining your people because and I think this is one of the things that also makes compensation for CVC so difficult is the base number is so small. I mean, if you've got 100,000 global employees and you've got 15 in your corporate venture group, you're like, okay, it's, what's 5 people? It's not a big deal, but it's a huge deal for the success of the program.
Let's talk through corporate stuff because it's,
Yeah, Jay, I was just going to say the one thing that sometimes people are surprised, at least that I've heard and sort of anecdotally when you put up that slide, is the difference between recruiting from CVCs and VCs versus PE shops and how it dramatically falls off in terms of those percentages. And I think that's just a feature of the type of investment and the type of atmosphere. And there is a distinct difference. And I think people recognize that. And it might seem like it's an obvious answer, but it might it really isn't. I mean, I think it's a different type of investment vehicle. It's a really different type of investment strategy, and so there's different skill sets.
Well, there's also a very big difference because we work with private equity clients and also some that have crossover funds and then some are straight VC. And we see the difference in terms of the number of jobs that they have because they're the private equity firms have put a big emphasis on like their investor relations teams versus the venture firms, and the corporates are putting much more of an emphasis on their portfolio services and the way that they're transferring and, you know, having recruiting and all kinds of skill sets and resources for the portfolio companies, because it's no longer just a straight investment model. There has to be some other resources for the portfolio companies, because otherwise you're seeing that you can't just throw money at it anymore. But the private equity firms, you know, it's something that the VCs are implementing too. And this is coming directly from the CVCs because they've done it so well. And there have been some very heady CVCs who were doing this 10 years ago. Right. And now, and we can get into these questions as well. I want to be sensitive. I know we've got about 15 minutes left, so I want to cover what makes sense. But we have a tremendous amount of data on those CVBD roles, those business development roles, because they're very important. And they've been a whole new lane in the corporate arena that really has also transcended to the venture arena too. I'm going to touch on the corporate stock, and then we'll move into the CVBD and wind up there. We also have, you know, data. We're running our survey now, which will send out the link, and everyone gets an access to a subset of the results for no charge on salary increases and what's happening with year-end bonuses. So we hope you participate, because we know that getting some of the information back will be helpful. So let's talk a little bit for a second on the corporate stock, because this is sort of part and parcel of most CVCs. So James, you want to fill us in on these different, like what the different implications are here in terms of these types of stock awards?
Sure. I mean, you know, you've got traditional sort of stock options, which are what most people are probably familiar with. They generally are part of if your company is publicly traded, part of a registered plan, where, you know, the company is allowed to sort of grant options that vest generally over time. Generally, you've got to be there, things along those lines. Then you move to performance-based options, which are exactly what they say, right? It's that same kind of concept of an option, right? You're not an actual equity holder, but you hold options in the company that vest not only over time, but on the establishment or the completion of certain milestones. And those milestones can be all over the mark. They can be financial in nature. They can be not only time-based, but exited in nature. So they kind of can run the gamut. And then, you know, restricted stock units, right? And you see this large sort of jump here. That's because it's what everyone sort of wants, and I think, and it's what the plan generally will provide the flexibility to provide for. I think the interesting part about that we sort of come into is kind of how you go about equating what the grant of the restricted stock unit is for those in the CVC world to those in the parent company world, because those metrics aren't necessarily going to be the same, and there's not going to be a way to necessarily balance them out. So the conversations we often see people having is trying to figure out what is the fair allocation of those matters.
Right. Okay, so let's look at vesting time. This is just interesting to see compared to the, you know, carried interest vesting, for example. So the vesting time for corporate shares tending more towards 3 years, sometimes 4 years, but obviously a shorter period of time. And this is the median cash value of the corporate share distribution 21, 22, 23 for the CVC unit leader and the senior investment professional. And you can see this is real money. I mean, this is what has been is almost consistent, right? Year after year after year. And this, like Lee, what you were saying, this actually is something that's given every single year, and it's valuable.
Yeah. And it ties their, you know, the retention goals to the corporation's goals and achievement of them, which, you know, as a CVC, you know, there's always a risk of getting too far afield from the corporation. You know, sometimes the best returns are ahead of the corporation. But I think it's also interesting to see how, you know, when we were talking previously about like carried interest, you know,
right.
Nice part of that is to be able to reward your investment team by allowing them to participate in the proceeds from their investment activity, and
right.
the upside potential in combination with, you know, the stock shares, you know, is really, you know, something that is really hard for VCs to compete with.
Right.
If you're successful, if you're getting the payouts, if the stock, you know, there's a lot of ifs, right?
But it's something that's consistent, and many VCs are paying just, you know, some base pay and some bonus. I was just working with a colleague of mine who's negotiating an offer right now, and the bonus is just based on if there are management fees left over. It's not, it's not based on other, and the more junior positions tend to have a base and bonus structure where the bonus is based on performance or some other metric because they have to stay competitive. But at the top levels, it's really a cash and carried interest equation. And you can see the carried interest is by no means a guarantee. It's also, you have to contribute capital, you have to fundraise, and also you have to wait for the vesting, which can be very lengthy. So
Right.
it's definitely not.
Another plug for your data that's really helpful is kind of, you can really drill down into things like that really help you understand how you allocate the carry across the team members. What, kind of what's an equitable distribution of carry points or synthetic carry, by position and what the norms are for that. So, just because the firm level carry is different than the individual carry levels, and looking
Right, we get into all the amount of carried interest distribution, we get into carry dollars at work. I mean, I want to focus on CVC, but on the VC side, which also we do ask these similar questions, albeit with different sample sizes. On the CVC side, we're very intimate with knowing, James, probably not as much as you because you're doing the formation, but I mean, it's also, there's no one standard. I mean, it's very complicated at the VC side.
Yeah, I would agree with that completely. And it's as Lee said, right? It's about recruitment. How badly do you want somebody, and for what purpose, and to what end, and how is your fund structured, whether that's a VC fund or that's a CVC fund.
Right. I'm going to move into as our last deck here. We have obviously a ton of information, and we have salary increases, bonuses. We have information on diversity, equity, and inclusion. But I think we touched upon the CVBD roles, and I think it's really important because it also talks about, so does your CVC unit have a dedicated CV business development sort of portfolio development team member? And you can see that the yeses are outweighing the no's, but are behind the no's, but this number is changing. And here is 2021, 2022, and 2023. So 2021 was obviously a very big year, but you can see that the 89 is yes, and that 102 is now yes for 23.
Yeah.
So that is growing.
I mean, what we're seeing is even with new programs, many of them are starting with the CVBD role in mind, even at the time of formation for corporate venture.
Right.
It's just so fundamental to their ability to deliver the value that comes from the portfolio of investments. And once they get to 8 or 10 companies, it becomes really difficult for the investors to do both the investing role and the landing role, if you will.
Well, this is it. This talks about the number of portfolio development, who's on the team. So it's marketing, the business development professionals and support staff, the technical and scientific specialists, right? If you're dealing with something in the life science area, or specifically now, obviously a lot going on with artificial intelligence and robotics, or a parent business domain specialist, or some operating support specialist could be talent. And this is also the part that's so interesting here, is that we're replicating this on the venture side as well. Mm-hmm. And here, where did the business development team people, where are they recruited from? And you can see mainly coming from the parent, from the inside of the organization, some rotational staff, and that's very important, sales, marketing, all of these areas.
Yeah, I would say it's especially important if part of your goal is the commercial aspect or the commercial agreement, so to speak, that comes out of a CVC relationship. And in some cases, even the way that they look at the investment is not so much on, the return on the investment, but what is the revenue being generated on a current basis with respect to, to the commercial arrangement that's in place, that's contingent upon the deal itself.
Right. Well, that's why we ask these questions about, does the CVC investment professional take a board seat or an observer seat when they're making the investment? I think the numbers here show that their level of, how they want, what their table stakes are and where they want to be thought of, and where the resources coming from the parent company are in terms of the consideration for the portfolio company. Lee, you're nodding your head because obviously you're involved in this, so tell us.
Well, I think one of the things we see is, to me, this is and I don't know if you have the year-over-year numbers, but they're obviously growing. And my sense of that is, you don't get a board seat unless you're a significant investor in the company. And, observer rights are fairly standard, but for a corporate investor anyhow, but to be able to get a board seat and to be able to fulfill your responsibilities well, you have to be a serious investor. You have to commit to follow-on rounds. You have to really have skin in the game. And I think that's part of the professionalization of corporate venture.
Well, and I would just add to that. I couldn't agree with you more. I'd add two things. One, you have to have buy-in from the parent company that
Right.
as you sit on the board, you are not representing them.
Right.
It is critically important that the CVC units understand that when they sit on those boards of those portcos, they are not representing their parent company. In fact, from a fiduciary perspective, they're required not to be representing
Right.
that. And that's, we are seeing a lot of conversation around board observer rights in connection with majority stakeholder rights, information rights, that kind of
Right.
sort of waterfall of events that in some cases, if you can get enough of those things, well, then maybe you don't need to be actually a board member. And then you can act with a little bit more independence. So there's a heavy conversation on the legal side that goes into those decisions.
Right. We ask those questions here, both this is how many board positions can you have, right? And also how many observer positions can you have? And that's exactly why, to go towards understanding, what is your level of participation. Here's the last slide, which I'm going to show, is that the portfolio professional, the year-over-year compensation. And you can see that has gone up in showing the role of importance here. We are currently running, as I said, I'm going to wind us up here, that we are currently running the salary increase and bonus survey. Is open. And it's on the whole Thelander survey tool. I'm going to put our plug in because there's no cost to participate, and you see how valuable this data is, and that there's nothing shared about any individuals. Sometimes the CVC unit doesn't want to participate with the full unit because they're not comfortable with that, but people on the team want to participate, and you're allowed to do that, and there will never be any gotcha. So we certainly would love for you to participate. We will send out a link afterwards. And thank you, James and Lee. It's always a great discussion, and I feel like we could go on and hit more and more areas here. But Lee, any wind up for us?
I just want to say thanks. I think the data and the fact that you have been at this for 25 years, it makes a tremendous difference for the industry to be able to continually improve and become more steadfast and to have more impact and to really deliver on the promise of what corporate venturing is all about. So it's great to have the data.
James, any wind up from you? You're off doing deals and DLAs, the firm, and you're the guys. So
well, I'm fortunate to work for an excellent international law firm with lots of capabilities and great partners and colleagues. But at the end of the day, it all comes down to clients and being able to work with them in a way that provides value, and that's certainly our goal, and you certainly help us achieve that goal. So thank you to the participants, and to Lee and Jody. Thank you.
Yeah, great. Thanks to all. You can see it's a collaborative effort, and we're all here in support together. And we wish you all well as you wind up towards the year end. And we look forward to hearing from you if any specific questions. We're certainly glad to speak afterwards. So thank you.
Thank you so much.
Yeah, take care. Thanks.